For anyone whose birth year falls before 1961, an incredibly important piece of financial reality often goes completely unmentioned. The amount being deducted from your monthly Social Security benefit to cover Medicare premiums this year has nothing to do with your current financial situation. Instead, the government determines this charge by reviewing your federal tax files from 2 years prior. If your income during that specific period happens to be higher than what you are bringing in today, you could easily be sacrificing hundreds or thousands of dollars annually based on an outdated financial footprint that no longer represents your actual life. Over the course of this discussion, we will break down exactly how this multi-year look-back operates, discover who is most vulnerable to these unexpected charges, examine the precise federal paperwork required to erase them, and reveal a hidden timing window that allows you to safeguard your retirement funds moving forward. Keeping up with the constantly shifting landscape of Medicare premium guidelines is vital because the retirees impacted by these sudden bill increases are almost always the last to receive an explanation. So if you or someone you care about is navigating this transition, sharing this information can help ensure it is seen before costly mistakes are locked in. To see exactly how this trap springs closed, consider the experience of an individual named Gary. At 67 years of age, he makes his home just outside Charlotte, North Carolina, having concluded a 35-year tenure as a structural engineer for a regional construction enterprise. Gary officially entered retirement in the latter months of 2024. As is frequent for individuals wrapping up a lifetime of employment, his concluding year of work generated an anomalous financial profile on paper. Alongside his standard wages, he received a year-end bonus distributed in December, which was further inflated by a lump sum payout for accumulated unused vacation days he had preserved for more than 10 years. Consequently, his documented earnings for 2024 climbed to the absolute highest tier of his entire adult life, despite the reality that by January of 2025, his active paycheck completely ceased. He shifted into a lifestyle sustained by a modest pension coupled with his monthly Social Security check, causing his day-to-day cash flow to plunge by more than 50%. The surprise arrived in the final months of 2025 when a formal notice from the Social Security Administration informed him that his upcoming 2026 Medicare obligations were set to skyrocket. His Part B premium was raised significantly above the standard baseline, and an extra premium surcharge was appended to his Part D prescription drug coverage on top of the standard base rate demanded by his private insurance provider. A bewildered Gary contacted a program representative because his current retirement lifestyle bore no resemblance to that of a high-income earner who should be penalized with extra fees. The agent clarified that what most people never find out is that the system is legally required to evaluate his 2024 tax filings, which captured the temporary spikes from his bonus and vacation payout, rather than adapting to his 2026 financial status. Gary observed that the federal government had essentially based his ongoing health premiums on the worst possible calendar year, capturing a temporary retirement anomaly rather than his enduring fixed income reality. To protect yourself, it is essential to understand the underlying framework of this penalty, as it frequently penalizes unsuspecting households across the country. This government surcharge is formally designated as IRMAA, an acronym representing the Income-Related Monthly Adjustment Amount. Rather than being an administrative error or a fraudulent billing scheme, it is an official component of federal law designed to determine if your previous earnings require you to pay more than the baseline amount for your Part B and Part D protections. Because our tax returns are typically not finalized when the government establishes the upcoming year's premium rates, Medicare systematically looks backward by 2 calendar years, relying on that older tax documentation for every single beneficiary nationwide. The exact financial metric scrutinized by the government is known as your Modified Adjusted Gross Income, commonly abbreviated as MAGI. For the purposes of calculating this premium adjustment, your MAGI is calculated by taking the standard adjusted gross income line from your federal tax return and adding back any tax-exempt interest you collected. such as the yields from municipal bonds, which are normally protected from regular income taxes. If your calculated MAGI from your 2024 tax documents exceeded $19,000 as an individual filer, or went over $218,000 for a married couple filing a joint return, you automatically cross into the threshold where the IRMAA surcharges are applied. Anyone landing underneath those specific dollar amounts simply pays the standard established premium. Once you breach those lines, however, the added fees escalate along a sliding scale containing 5 distinct tiers, where the combined monthly increases for Part B and Part D can range from roughly $1,148 annually at the lower end up to a maximum of approximately $6,936 per year for a single individual. For a married couple where both individuals are enrolled in Medicare, these steep financial penalties are doubled because the surcharge is assessed on an individual basis for each beneficiary within the household, rather than as a singular joint charge. The detail that catches retirees off guard is that these income thresholds operate strictly as a financial cliff rather than a gradual slope. There is no proportional phase-in period for these rules. If your calculated income exceeds a tier boundary by a single dollar, you do not face a minor or fractional increase. Instead, the entire weight of that next tier surcharge is levied against you immediately. For instance, allowing your income as a single filer to tick upward from $18,999 to $19,001 does not merely cost you an extra $2, but can instantly trigger over $1,000 in mandatory annual premium increases because stepping across that boundary inflicts the full financial weight of the higher bracket. This unforgiving design is precisely what impacted Gary, whose final corporate bonus and vacation payout did not need to elevate his wealth substantially to disrupt his retirement budget. They merely had to push him over a single statutory line to invoke the full tier surcharge across his entire premium structure. It is a common misconception that these surcharges only penalize the truly wealthy, when in reality, they consistently snare middle-class retirees due to isolated, non-recurring life events. The standard catalysts are rarely sustained high salaries, but rather one-time transactions that temporarily distort a single tax return. A final year of career compensation featuring severance or banked time payouts is incredibly common. Other frequent triggers include substantial one-time distributions from a traditional IRA or 401k to fund a major residential project or assist a relative with a real estate down payment, selling a primary residence or a plot of land that generates a taxable capital gain, receiving a pension as a singular lump sum payout rather than a monthly stream, or executing a large Roth conversion where funds are moved from a traditional pre-tax account into a post-tax vehicle. While a Roth conversion is often done intentionally to minimize long-term tax exposure, something the SSA rarely explains clearly is that the immediate jump in that year's MAGI can inadvertently trigger a severe Medicare premium penalty 2 years later, treating a strategic financial shift as if it were permanent wealth. Many individuals mistakenly believe they are protected by a regulatory safety net known as the hold harmless provision. While this rule is designed to ensure your net Social Security check never decreases from 1 year to the next due to standard Medicare Part B premium hikes outpacing your annual cost of living adjustment, it offers zero protection against IRMAA. If your income subjects you to these income-related surcharges, you are entirely excluded from the hold harmless protections, meaning your premiums can escalate dramatically even if the increase completely wipes out your annual Social Security raise. To put this in perspective, the average monthly Social Security cost of living raise for 2026 amounted to roughly $56, while the baseline Part B premium increase sat at approximately $18 for the vast majority of beneficiaries, allowing standard recipients to retain a portion of their raise. However, for a retiree pushed into a new income tier, the resulting surcharge completely eclipses that modest boost, leaving many people feeling as though their monthly retirement check has actually diminished in value despite the official cost of living increase. Fortunately, an official remedy is built directly into the federal system to address this exact discrepancy, yet a vast majority of eligible individuals fail to utilize it. The corrective tool is known as Form SSA-44, officially titled the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. The specific function of this document is to formally notify the Social Security Administration that the historical tax return currently dictating your premiums no longer matches your active financial situation, thereby requesting an expedited recalculation based on your current lower income reality. However, navigating this process successfully requires strict adherence to federal guidelines, as submitting this paperwork incorrectly results in a swift automatic rejection. The government will only honor Form SSA-44 if your income reduction was directly caused by a legally recognized qualifying life event, which strictly includes retirement or a reduction in your active working hours, marriage, divorce, or annulment, the passing of a spouse, or the sudden loss of an income-producing asset due to a natural disaster or similar uncontrollable circumstance. Understanding what the government refuses to accept is just as critical as knowing the permitted criteria. Voluntary actions, such as a conscious decision to liquidate stocks, an intentional Roth IRA conversion, or experiencing an exceptionally profitable year in the financial markets, do not qualify as life-changing events, even if those specific choices are the exact reason your income crossed into a higher bracket. Form SSA-44 exists strictly to provide relief for major structural alterations to your life status, rather than to bail you out from the predictable tax ramifications of deliberate financial choices. Gary's scenario of retiring and seeing his cash flow diminish because his career concluded represents the archetypal example of an authorized qualifying event. If your specific income spike was caused by a voluntary transaction like a Roth conversion, this particular form cannot assist you, and you must instead rely on proactive, multi-year planning strategies. If you do meet the official criteria for a life-changing event, the step-by-step resolution involves downloading Form SSA-44 directly from the Social Security Administration website or requesting a physical copy via their primary telephone network. Next, you must assemble official verifications documenting both the life event itself and your newly reduced income, which typically means securing an official retirement letter from your former employer alongside a verified projection of your current year's earnings, or a death certificate accompanied by an updated single-filer income layout. Finally, you must complete the document fully, attach the supporting verifications, and submit the entire package to your local Social Security branch either by mail or in person. Once your package is systematically reviewed and authorized, the Social Security Administration will adjust your upcoming premiums to mirror your current financial profile rather than the outdated tax return. It is vital to act quickly because these adjustments generally become active starting the following calendar month rather than retroactively reimbursing you back to January, meaning the speed of your submission directly dictates how quickly you stop overpaying. This highlights a critical planning window that occurs during the 2 years immediately preceding your enrollment in Medicare, typically when an individual is 63 or 64 years old. Because of the fixed 2-year lookback delay, any major financial transactions executed during this pre-Medicare window will not impact your premiums until you are actively enrolled. Therefore, if you are still within this window, it represents an ideal time to complete necessary transactions like Roth conversions because the immediate tax hit occurs while your income is lower from reduced work, and the resulting premium surcharge will not manifest until 2 years later, giving you ample time to adjust your future income below the thresholds. Conversely, once you are actively enrolled in Medicare, you must monitor your annual MAGI meticulously to prevent crossing a threshold by even a fractional amount, as you are then subject to a rigid 2-year lag that works against your financial interests. As you monitor these financial boundaries, keep in mind that the income thresholds for the first 4 brackets are adjusted upward annually to account for inflation, whereas the 5th and highest tier remains frozen under current rules. If your household income sits near any of these tier boundaries, even a minor influx of unmanaged revenue from stock dividends, savings interest, or an isolated investment distribution can mean the difference between maintaining a standard premium or being saddled with an expensive monthly surcharge for a minimum of 12 months before a recalculation can be pursued. To be perfectly clear, this dynamic does not mean every single retiree is being systematically overcharged by the government, as the absolute majority of Medicare beneficiaries fall comfortably below these income lines and never owe an extra dollar of surcharges. This information is specifically vital for a distinct group of individuals who have encountered an unexpected or structural shift in their lives, leaving them penalized by obsolete data. After discovering the existence of Form SSA-44, Gary gathered his formal retirement notification, compiled clear proof of his current lower income streams, and submitted the completed package to his local office. Within roughly 6 weeks, his appeal was finalized, and his monthly premium dropped back down to the baseline standard for the subsequent billing cycle. While he could not reclaim the funds he had already overpaid during the months prior to his filing due to the forward-looking nature of the correction, his future monthly savings were secure. Gary noted that this entire issue could have been resolved much sooner had any official entity or former employer simply informed him that this corrective mechanism existed. Ultimately, Medicare determines your current obligations by looking at who you were 2 years ago on paper. And if that portrait does not match your present reality, the responsibility to correct it falls entirely on you. If you or someone you know has been in this situation, share this so they can see it in time, and drop a comment if this is something you have been dealing with. You are not alone in this.